Yeah, thanks, Jamie. I think we should probably put a timestamp on this, shouldn't we? It's sort of just past 11:30 on the 10th of April. So anything that we do say today is possibly sort of defunct by the time this gets published. But yeah, interesting week. Obviously, the tariffs were introduced. They were far more severe than the markets were predicting, and we had that really strong sell-off that sort of precipitated from there. And then, obviously, Trump yesterday made the whole world an insider in the biggest trade of the decade. We've got the Trump put that's in place. I think he was more looking at the Treasury market than he was looking at the S&P. We know he wants cheaper borrowing costs for the US. He wants a weaker dollar. And as you say, there was the Chinese bank dumping their treasury stock and forcing the 10-year yield upwards. So Trump has intervened, paused tariffs now for 90 days, though we do still have those sort of 10% tariffs across the board. And now we have a significant trade war between the world's two biggest economies. So a lot has happened in a week. A lot is still happening. So we're just watching things sort of unravel from here. And I do hope, that this reaction was, in looking to control yields on treasuries, bring that borrowing cost down. It was not something, a little more. We don't know. You worry about contagion at times like this. Was something unraveling, sort of beneath the hood, something a bit more sinister, and the move was prevent sort of market contagion more broadly. But that's something we don't know at this stage. But for now, a bit of a relief rally, but we are sort of 10% down from the market peak for the S&P from mid-February. And I think for us, it's wait and see. Don't make any dramatic movements at this point. I was emailing clients yesterday before the announcement saying, the best days often follow the worst. So be patient, ride it out. We've got your time frame sorted. And now I'm just about to email them again after this, sort of congratulating myself for being sort of prophetic in how I predicted that. So strange times, a lot going on. And this is not going away anytime soon.
Of course, that sort of daily change in share price kind of narrative, I think, is kind of almost consensus at this point under Trump. And really, it should come as no surprise if you look at the history, taking out full-page ads back in the 20th century to sort of talk about how in favor of tariffs he is. It's just he now has the mandate to go ahead and do these things that he probably wanted to do before. As you say, expecting that this isn't the last of this conversation. Are there some areas you're looking for defense at the moment within your portfolios? Are there sort of, pockets of potential opportunity to sort of iron out that volatility?
I just think back to where we were sort of prior to this week. We had DeepSeek and the challenge to the apparent dominance of US tech in this AI arms race, and really in these sorts of environments, obviously with tariffs coming in, that's going to put pressure on the US consumer still. We are expecting that to be inflationary, and all of this uncertainty impacts confidence as well. So corporate spending and hiring, that's potentially on pause with all the uncertainty that we're seeing. And the playbook for times like this is just sort of diversification. You just want to hold broad thing, broad across the equity market. We've been talking a long time about the concentration of valuation risk in the S&P. We were seeing that sort of play out even before we were really laser focused on these tariffs. So diversification across the equity markets. Again, prior to tariffs, we were seeing sort of Germany hit the stimulus button and sort of doing a lot of spending there and impacting other regions. So just being a bit more spread out than sort of like an ACWI tracker or something like that. Again, holding things like the equal weight in the US to diversify your exposure to the Mag 7 is how we've been positioned and continue to position ourselves going forward.
That equal weight trade obviously being a bit of a classic for investors over the past few years, trying to broaden out that US story. Nathan, coming to you, sort of similar question. Really stock taking over the last week. What's been the sort of view in-house at Marlborough? And after the pause yesterday, what's the view going forwards? How is the sort of positioning evolving?
Yeah, so I think coming into this year, we felt that there was going to be a lot of volatility in the first half. And the reason behind that is because Donald Trump, obviously the first time he got elected, tariffs is something that's really close to his heart. But he led with the pro-growth policies first. So the tax cuts, the deregulation, and all of that really helped the market. And then towards the end of his term, he started to deal with tariffs. And that was obviously not really pro-growth or business-friendly or market-friendly. So I think his key learning coming into this presidential term was actually, if I'm going to do that, I'm going to do it the opposite way. So deal with the stuff that is less market-friendly first, and that's tariffs. And we've seen that exactly play out. So when it comes to the strategy has just created a lot of uncertainty. So it's almost wearing down the competition because everybody's just chasing their tail. And he's getting people to the negotiating table. And when they get to that negotiation table, they'll have almost given up. So I do think there is a bit of a tactic there on that side. But to us, clearly, what he's trying to do is isolate China. So when you saw the first round of tariffs being put in place, you had China, you had Mexico, you had Canada. There was a reprieve for Mexico and Canada, but not China. So every time they've just ratcheted up the tariffs on China. And even this time, what they're doing is they're going to get every government from around the world to the US. And I expect try to push a positive US agenda, as in an anti-China agenda, ultimately. So I think that creates opportunity when you think that through. The challenge is all of this creates uncertainty for market participants, for corporates, for consumers. And if people are uncertain, what they do is they tend to retrench. So if you're a company, are you going to spend money on that big planned expansion? No. If you're a consumer, are you going to spend on XYZ when you have all this uncertainty? No. And even for investors, they're concerned about what lies ahead. So that's the big challenge that the Trump administration has. And if we look at this week specifically, what fundamentally happened was you started to see concerns within the bond market about all of this uncertainty. And you had a lot of hedge fund traders caught offside, and they've got big leveraged positions into these fixed income trades. So it's called a basis trade. So basically they buy treasuries and they're picking up futures on treasuries and fractional price differences, but they're leveraging those up to 100%. So because China dumped all of these bonds all at once, that caused a lot of hedge funds to lose money in really short order and unwind positions, which was the potential for financial instability. So Trump is kind of seeing this, everybody's ringing him up and saying, what's going on? And he said, okay, we need to fix this. The end goal is China, but let's accelerate this. So that's kind of what's happened. I think from here, we've had peak noise because, a blanket tariff on the whole world, that's as bad as it can get. And fundamentally now what you're going to see is tariff negotiations with single countries. And, whatever the outcome, that's not as bad as a blanket tariff on the whole globe. So that's the good news. The question is, how quickly will markets forget? So markets always move on. We always have events. There's always uncertainty. Markets move higher, change in technology. But how quickly will they forget about the uncertainty the Trump administration has caused? And how quickly will the Trump administration move away from that? And that's the challenge. So for us, in terms of positioning, last year, when we were coming in to this year, we felt, okay, things are going to be uncertain. And there's a lot of things you can invest in today which create downside protection and are cheap. And it gives you a potential recession hedge if we were to have one. So things like long duration gilts, they look attractive. Things like infrastructure, that looks attractive. Things like UK equity, that looks really attractive. So these are areas that we went overweight, feeling they're going to benefit from rate cuts, but also give you a play on duration or recession hedge. And as it stands today, one area that we're less positive on is US equity. And this is it's a big one for people to call because US equity has been that shining light for so long, but US exceptionalism is now under question. And uncertainty obviously is impacting the US market. It's not one of the best performing markets this year. It normally is. And you're seeing other areas coming to the forefront. So for us, the challenge is it's just about corporate America, how much they retrench given all of this uncertainty. And we still think, the US is an exceptional market full of exceptional companies, but we think there's going to be an air pocket within the market, and hence we've got that position on today, and we think we'll have an opportunity to reassess that. So obviously we've seen this knee-jerk reaction, but often, as Dan quite rightly points out, those biggest down days are followed by the biggest up days in very short order. It normally happens within 2 weeks. And we've seen exactly that. But I think fundamentally, I would say we're cautiously optimistic because there's just so much happening in markets. But we do think there's lots of opportunities. And actually, China, despite all of this, looks really interesting because their response will be to respond, as in fiscal stimulus, and also to negotiate deals with the rest of the world. So if you look at China's proportion of global trade, 2018, they had tariffs from the US. Their trade globally didn't go down. It went down with the US, but it went up with everybody else. So you just have to think of it from that perspective. China will trade with other countries. And because of what's happening in the US, then some countries may decide, actually, we need to move closer to China because of all of this uncertainty. So to me, Trump is almost walking this tightrope, trying to achieve the goal of making America great again by reducing government structure, reducing reliance on the US by the international community, and creating growth in the economy. So to get that balance right, he now knows that that's difficult. And we're seeing that play out in markets.
Chris, I'm sort of very keen to hear some of your views on regional equities here. I know we talked about opportunities in UK equities, but Nathan mentioned this idea of an air pocket or an air bubble. I don't want to misquote you on that one, Mr. Sweeney, but basically, opportunities potentially in mainland Europe, UK, obviously, because of the trade deficit they have with the US, and obviously this interesting narrative around China. Where are you seeing opportunities on the equity side at the moment?
It's just interesting because it sounds like our portfolios are really, really close to Nathan's, but we come at it from a totally different point of view. I think it's, at the moment, you're trying to pick the least worst asset in a multi-asset portfolio. And so I wouldn't regard it as a world of opportunity. There's some nice pricing developing. I like Japan. I'm looking at that a lot. It's being hammered much more than the currency is going up. So that sort of inverse correlation is gone even more into sort of a crazy skew, but I'm not ready to buy it. I think it's very hard to buy or to sort of increase your risk while GDP forecasts are coming down all over the world. Inflation forecasts are going up all over the world. And it's just a matter of wait and see for the next few months where those forecasts settle, where the economy actually settles, and where the obviously lower level of corporate earnings will end up settling. Least you want the least dirty shirt, I think was the expression that's being bandied around a lot. Like Nathan, we've just literally this morning got rid of a lot of US equity, and we've replaced it with the iShares MinVol ETF. It's been a pretty good defensive holding, whereas our US equity was in the S&P equal weight, which has been just useless and very disappointing. And I think the whole concept of equal weight has just gone out the window over the last couple of weeks. So I can see a lot of people, questioning whether that is really worth holding at the moment. So we basically executed on. And the reason is that, look, we had a 9.5% rally on a 90-day pause in the trade war. It's not good enough, right? We need a bit more positivity than that for a 9.5% rally. And it was a curious echo of the rumor last week that set off an 8.5% rally that was going to be a 90-day pause in the trade war. So it felt a lot like a short squeeze. Tariff's still a weapon. Trump isn't going to back down. Very hard to negotiate with a man who's unreliable and is not negotiating in good faith. And I think governments, unfortunately, have to be aware of that. Those negotiations will be volatile. We saw it in Trump 1.0. Negotiations with China were, one step forward, two steps back, actually, a lot of the time, as he, used a lull in the negotiations to then hit them with harder tariffs. And so he's not a reliable person if you're an investor hoping for good outcomes here. The weighted average tariff in the US has gone from 27% yesterday to 24%. It's not a big difference. And that's, of course, because the tariffs on China have gone up. So the US consumer is still in a bad place. So those GDP forecasts for the US aren't going to change much at all. And of course, the auto tariffs and others are still in place. So there's not really a great change for the US, economy or consumer, which of course has been the cause of US exceptionalism for the past few years. So a bit, I think, disappointed really. And so we just took this market rally as a chance to sell out of our US equity at a much better sort of price. I think, your economic policies are not going to lead to growth if the assumptions underlying them are flawed. And they're deeply flawed in the US at the moment. And that's why we are seeing economic forecasts come down. The 10% universal tariff is still in place. This is a very bad outcome for the global sort of trade marketplace. We still have the EU's retaliatory tariffs to deal with on steel and aluminium, although I saw on Bloomberg they're thinking of pausing those, but that would be another catalyst for a market sell-off. And all of this rally has been achieved, and markets are up, and that's great, but the geopolitical risk with China has gone through the roof in the last 24 hours. You can't keep poking that bear. Mm. Something is going to break in that relationship, and the obvious card that China have not played is Taiwan. Mm. And all they need to do is threaten Taiwan with something a bit nastier than a naval exercise, maybe some kind of trade blockage, blockade, for anything like that would absolutely decimate the US stock market. Wouldn't be very good for China, obviously, but it would decimate the US stock market because all those tech companies depend on chips from Taiwan, and your AI, the future of AI is dependent on Taiwan being independent and secure from China. So China actually has a massive leverage geopolitically. And so I worry that we've seen an increase in geopolitical risk, which markets just can't price. They never price until obviously the event happens. And we're up 9.5%. And so for me, it's this is a chance to take risk off. We've been low risk for a long time. We do own China. It's obviously hurt us. That's the only sort of market where I think we're overweight. It's hurt us a lot in the last week. I think one other thing I'd add is, overt market manipulation by Trump. So if you're a sovereign wealth fund with, $1 trillion under management, you actually have a list of marketplaces and whether that market integrity is good enough. And the US has now dropped to the bottom of that list. Right, before it was the Nigerian stock market, it was the Chinese. Now the US is right down the bottom of that list. And these guys have got a generational mindset. If the marketplaces you're investing in cease to tick your compliance boxes, there's going to be a problem. And I think if you're a big sovereign wealth fund, particularly, the Norwegians or whatever, the sensible ones, you're just going to have to pull back. And obviously you're illiquid, you can't do it overnight, but there's going to be a sort of a constant drain of money out of the US stock market, which will just, make it more vulnerable. And so what I see is next few months, not a lot of good news, not really good news. A 90-day pause, it's not really good news. It's just a little bit of relief in amongst a lot of bad trends. Lot of volatility and not much return. And people will just get sick of that. As I think Dan said, they're getting a bit sick of Trump. He's kind of negotiating them into exhaustion. But I think it's going to be the same for investors. And that's not actually where you add risk. Yeah. If you're exhausted as an investor, you don't add risk. So I can't see anybody adding any risk, frankly, for the next few months, which means we're just in a grind down with some nasty volatility. And as I say, your sort of most important holding in your portfolio is now extremely volatile without a lot of kind of upside. I mean, what do? You cut risk.